So I'm back here with KP Reddy today, the founder and CEO of Shadow Partners. And one of the things that we've been doing is going through some of his LinkedIn posts. If you don't follow KP Reddy on LinkedIn, you need to. K.P.Reddy, Reddy on LinkedIn. Uh, Many intriguing posts, many stir up a lot of comments, a lot of reactions. And so we've started this series of unpacking KP. So basically, what were you thinking? What was going through your head when you wrote that post? And so I was reading this one this morning. You actually posted it this morning as we're recording this. So I'm going to give it at least a portion of it a read, and then we'll start to unpack it.
Sounds good.
It's interesting how investment illiquidity is often considered as part of risk variable. One could argue that investments with high liquidity, like public stocks, have a higher risk because emotion can drive poor decisions. For example, you invest in a private equity fund with annual redemption windows. So you go on to explain more about that, but why did illiquidity come into your mind as you were jumping on LinkedIn this morning and you're getting ready to post?
So a lot of people ask me, like, KP, how do you come up with so much content so consistently?
Yeah.
I have the benefit of talking to like 10 or 12 people a day. It's my job. I
Right.
also consume about 2 books a week. That's a pretty good cadence for me. And I've been reading this book, Same as Ever, by Morgan Housel. He's a super interesting dude. But he basically, his thesis in his book is that like nothing changes. Like the Great Depression, the Great Recession, like they're all the same. So what was interesting was he was talking about risk, and risk being the unknowns. Everything else is like trackable. It's really the unknowns. It's a pandemic. It's a 9/11. Those are the stuff that nobody can really factor for. And so even as I look at my own investing strategy, of course, I have the venture capital firm and I have my family office and, do personal investing and all that, is how do I think about risk? It really opened my idea about like risk. And this idea of illiquidity takes the people factor out of it. In other words, if tomorrow we hear something, we're like, oh, I want to do Bitcoin. I invest in Bitcoin. All it takes is 4 or 5 tweets to change the market sentiment, and then you're selling out of Bitcoin. Versus something that I invest in and I can only maybe take money out of it once a year or once every 5 years or once every 10 years, like whatever the time horizons are. There's a bit of a set it and forget it. And also this idea that nobody else can get out either, right? So a lot of this, like getting out of the stock, it becomes like a mad rush, kind of like a run on the banks that we had earlier this year with Silicon Valley Bank. It was all people driven. And if you look at how social media works, if you look at email and how quickly the group, I probably have 15 group texts on my phone. Word gets out very quickly. People don't do research. They grab a soundbite and they're like, oh my God, did you see Microsoft's numbers? And disclaimer, this is not investment advice. But the question really is, if you're signing up for a 10-year investment cycle, you kind of set it and forget it. And whatever bumps in the road happen, you don't care. And you're not emotional, and neither is anyone else. I think which is fantastic because nobody else can get out either. But in the public markets, one, they're just so consumer sentiment driven. Now you have this thing as we go into the fourth quarter where mutual funds will start to sell certain stocks just to make their portfolio look good by the end of the year. In other words, they were in a dog all year, but they're going to sell it so that when they report in January what stocks they were in, it's the end of the year window dressing. Well, God forbid you have a couple bucks in one of those stocks and you're down 20%. And I know I've done it. I've been an emotional investor. Oh my God, this, it's a falling knife. I better get out now. And then I look back at those same stocks a year or two later, and they're up 20, 30%. But what did I do? I took liquidity out. I'm like, oh my God, I didn't need the money, right? I'm fortunate I don't have to pull money out to like pay a medical bill. But I pulled the money out and I was like, okay, I think this other stock is a better bet. Then I go look at that other stock and it's probably down. So what was the point of all that? So I think operating on emotion, that the liquidity actually drives much more emotional behavior Now, I do believe if you have money in a liquid situation, right? If you need the money, 100%. Like, hey, I've got college tuition coming up next year. I need to make sure I can get the money out, and then you're operating in a more conservative manner. But with the higher interest rate environment, you're seeing all these CDs. I saw one the other day, 18-month CD, 5%. Now you have to tie it up for 18 months. So there's no liquidity. And then they're only giving you 5%, which some people say 5% is fantastic, KP. That's better than my checking account. Yeah, but your checking account, you can take it out, right? So I look at it and say 5% is not good enough, because the opportunity cost that what I could be doing with that money is much better, kind of in, for an 18-month cycle, tying it up for 18 months. So I think you have to bifurcate liquidity as a risk quotient and make it part of your plan. If you're like, KP, I want to buy a second home, it's going to be in 10 years. I mean, why would you put it into a public company and then you're going through the ups and downs, and then 3 months from now you're like freaking out because the Fed did something, right? And you're selling out your position. It's like, but dude, you didn't need it for 10 years. Like, why are you all fired up about it? So that's kind of where it came from. That as you start seeing, the end of the year, there's some highly predictable things. You can do all the charts. There's always a Santa Claus rally. There's always a post-Christmas sell-off. And one of the things people never look at in public markets is not only is it the movement of the stock, but it's also the volumes. A stock can go down on low volumes and you're freaking out. And it's like, well, if you don't look at the volumes, it's like, well, a small portion of people are unexcited about the stock, so they're selling off. And oh, by the way, it's the day after Christmas, and none of the billionaires are playing stock market the day after Christmas, right? So they're too busy at their islands or whatever. So anyway, I think as a mindset of how we think about investing, I just really feel like liquidity actually drives kind of bad emotional behavior.
That makes total sense. I mean, many of us are driven by emotional decision making. I mean, our brains work that way. Is there a correlation? I mean, you mentioned the VC side. Is there a direct correlation, in the from here to the conversations that you have on the VC side when you're thinking about different funds and investments and, speaking generally?
Yeah, I think, look, if you're an individual, a high net worth individual, and you're 90 years old, and you're investing in a 10-year fund, right? You're not investing for yourself. You're probably investing for your trust. You're investing for your family. And so I think it comes up a lot, mostly because we're a small firm. So we don't have teachers unions and all, they're highly sophisticated. I would say probably 80% of our investors, this is the first time they've ever even looked at a venture fund. And I see it in their eyes when we're talking to them about, like, 10 years, man, 10 years. And it's like, well, no great startup was built in 3 years, right? These things take time, and therefore, they need the money, right? They need the money over a long period of time. So it does come up a good bit, but it's not for everyone.
Sure. Yeah.
Every investment is not for everyone, and you do, once again, not giving investment advice, disclaimer. But I do think younger people should be thinking more long term.
Mm-hmm.
Because they have a little bit of more of a set it and forget it mentality, but definitely don't invest money that you might need. Right.
Yeah. That makes a lot of sense. So if you miss this, or if you have not yet seen the post on LinkedIn, so again, follow KP on LinkedIn. I mentioned the way our brains work. He mentions the lizard brain in the post itself, so that's worth the price of admission, if nothing else. But check it out, KP Reddy on LinkedIn, K.P. Reddy on LinkedIn. If you don't already follow him, I'm assuming since you listen to this, you probably do. But this is a series that KP and I do where we take a few of his posts and I ask, hey, what came to mind? What was it that inspired this particular post? And this one starts out, it's interesting how investment liquidity is often considered as part of a risk variable. So KP, thanks for enlightening us, letting us sort of get a peek behind the curtain about what you were thinking about when this post came to mind, you started typing. If you're listening to us now, again, subscribe here, and we'll be back again next week with another Unpacking KP.